Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, all eyes on tech earnings today. Meta and Microsoft, but also chip names. Qualcomm and ARM all reporting after the closing bell.
Plus, Palo Alto Networks buys CyberArk for about $25 billion in cash and stock. We'll discuss with the two companies.
And Anthropic's nearing a deal to raise as much as $5 billion, which would value the AI startup at $170 billion.
Meanwhile, let's talk about the public markets. Anthropic not on there yet, but we look at actually a little bit of risk-on attitude ahead of a huge day, Ed. You mentioned the earnings after the bell. We've also got the Fed decision that comes slap bang in the middle of the trading day. Scott Bessent, Treasury Secretary, saying he wants a little bit of imagination from the Fed. We're up 0.3%. Big tech managing to drive us forward. What are you looking at on the micro points?
Yeah, unusually I'm going to go to the private markets. Big story that Bloomberg broke in the last 24 hours. Anthropic raising $5 billion, $170 billion valuation. Later in the program, we'll get the details from Kate Clark, who broke that story. But it's a massive jump from the valuation earlier in the year. Earnings is everything right now. We get the first of the two Mag 7 names after the bell, two more tomorrow. But we're looking at capital expenditures. That's the clear story for both Meta and Microsoft. And then in the chip sector, you have ARM and you have Qualcomm. We're thinking smartphone, we're thinking laptop, and tariffs probably as well. My goodness, what an afternoon we're in for.
And we brace ourselves. Let's get more ahead of those big tech earnings. Meta, Microsoft. Here to talk about what to expect, Bloomberg's Ran Vestelika. And look, the valuations are enormous for these companies. The expectations are high. What will we hear on capital expenditure, do you think? Is it going to rise?
I'd say that's the consensus right now, especially at Meta, which has been extremely aggressive in all of its AI plans. I'm sure you saw the story that Bloomberg had about the $200 million pay package for one AI engineer. A lot of acquisitions they've been doing, a lot of talent buying, and of course a lot of spending on data centers and AI and NVIDIA chips, so on and so forth. So I think especially there, people are expecting to see a lot of spending, and also at Microsoft. Maybe a little bit less aggressive there, but certainly these are two of the biggest customers for NVIDIA, and they're also two of the biggest outperformers this year, at least among big tech. If there's any disconnect between that, that's going to be the real focus for tonight.
Ryan, I really appreciated how you and Felice sort of framed it in your story. Meta has capital expenditure growth of 100% year on year, probably. Microsoft 30%. But on the top line, you're going to get 15% growth and 14% growth, respectively. Where is it that the sell side are most focused? What is the metric that they're looking for? I think particularly in Microsoft's case as well.
Microsoft, the focus is, as usual, still going to be on the pace of Azure growth. That's its cloud computing business. People are also looking to see if they say anything about what kind of impact AI is having on sort of overall demand for Office, for with its Copilot product, things like that. That's going to be a real focus for them. I think people are growing more comfortable with just the level of AI spending so long as these companies can show that they are seeing a return on this. Last week, of course, we had Alphabet also increase its CapEx plans by quite a bit. People were okay with that because people feel like this stuff is going to pay off, especially over the longer term. They are really sort of developing a moat in terms of their AI businesses. So far, we haven't seen too much caution, but like you said, expectations are getting higher and higher. The stocks have been doing extremely well this year. It wouldn't necessarily be surprising if we did see a pullback on these news.
Ran Vestelika is going to be all over those numbers when they break after the bell. Let's now turn to our first guest, Uday Chiruvaru. He's a portfolio manager at Harding Loevner, a $55 billion asset manager. You have Microsoft, you have Meta on your global strategy. Among them, an easy question, or maybe a simple question, we'll see how hard it is to answer. Is it vindicated, this capital expenditure increase?
Look, the capital and expenditure is bigger than what we've seen for many years, and it's historically high proportions. Now, as investors, we're patient right now. I don't know how long our patience will last if we don't hear the real monetization and productization story from Meta going forward.
Let's talk about the prioritization. Interestingly, Mark Zuckerberg has put out a post, both video and text today, trying to say why personalization is important when it comes to superintelligence labs. Do you understand the business case as to why Meta needs to win that race?
I understand the business case because if they don't do it, someone else will do it. And then engagement goes to the person who does it. So that's the first reason I think why he's doing it from that perspective, to increase engagement and then convert that to monetization later on. But what's less clear is what that means for the next TAM that they want to hit. Because at the end of the day, there's a limited advertising market. And as much as Medic wants to, they can't be 100% of the market. So they've got a ceiling. They need AI to raise that ceiling, and that's where the question mark for us as investors comes to.
Udi, forgive me on this one. Sometimes markets and Wall Street and technology investors can have short memories. Do you remember when we were talking about the year of efficiency? And if I were to show you this chart of capital expenditures from Meta, and you look at the beautiful green column that shows $72 billion at the upper end of the range, and the idea, maybe that column could go up even more. How do you reconcile that as a Meta investor?
So I think when we look as Meta investors, what we see right now is revenue growth. Revenue growth has been coming from their core business, which is their advertising business. So what they've spent on AI so far has been driving that growth and has been improving the rate of change of growth over the last few years. So that justifies the valuation for now. The question is, if they continue on for 1 year, 2 year, 3 year, that's when as investors we start getting worried. And I think if you go back 5 years, that's what happened with the reality labs. Like the first year of reality labs, second year of reality labs, people say, hey, look, we can understand what that is. But then you got to the third and fourth year and said, well, hang on. All we see is losses. We're just not seeing the revenue generation coming out of this. So we're at that early stage. So that's why as investors we're patient. But I think we are going to be asking more and more questions. Right. What's the monetization story? And what's the next step that we should be looking at as a product from this business?
Udi, I'm jumping ahead 24 hours to Apple, but the news story this morning was the president talking about tariffs with India. So we did the analysis and we looked at the phone supply chain and assembled phones coming out of India, and we have that data. It's a really interesting market for Apple, but the story still seems to be a heavy reliance on supply chain and end market in China for Apple.
Yeah, I mean, at the end of the day, Apple still remains primarily driven by two things. One, their services, and then the phone growth. What we haven't seen is an expansion into a new product line, something that I think is required for Apple to take the next step for its valuation to make even more sense. What these tariffs will do is make the price of phones higher, and that's what we saw. And I think in Verizon's results, they said there's been some pull forward of buying of phones. What that means for Apple, not sure yet. They're coming up with a foldable phone. How that will impact investor demand, consumer demand is also questionable. So from the way we stand right now with Apple is, it seems to be an expensive valuation if there is no next story to this.
Let's go to the story of Microsoft as they come out after the bell as well. It's interesting, we talked hardware with Apple, a little bit with Meta as well with their hardware. Microsoft, the winning formula has been cloud and Azure. How much do you need to see how much AI is incrementally improving and fast-tracking that growth?
So I think it's not how much, it's the trajectory that we want to see. We want to see positive trajectory compared to last quarters. And then we want to see comparison of them to Google. Google showed a 30+% growth in their cloud business. We want to see roughly around that at least for Microsoft. And then from that point of view, they've got other levers. It's not just cloud growth, it's also, as I said, Office. How much is Office take-up going? How much are people going up the premium tiers in Apple subscriptions to take on AI? So it's not just how much cloud AI is coming through, how much AI is percolating into other products that they're selling, and what premium pricing can they get out of that is what we focus on.
And what was so shrewd of Satya and Microsoft writ large was their relationship with OpenAI, very early innings, and integrating that within. But almost there's a frenemy relationship going on. There's a competitive instinct. We understand that, of course, OpenAI trying to restructure its own self into a for-profit, and maybe we see Microsoft have access to their technology for a bit longer on the back of that. How do you think that relationship is going, and how much do you think Microsoft can compete almost against the company it helped bore?
Yeah, look, it's hard to sit from the outside and say how that relationship is going. But what we can see is OpenAI is now going aggressively into the enterprise software space. What that means that if not today, tomorrow they will start competing with Microsoft on certain product lines, not across the board, but on certain product lines. So that will put strains on that relationship. And that will mean how do they negotiate the technology transfer between those two, and how do they translate in terms of distribution? Because OpenAI is using Microsoft for distribution at this point in time. So to me, it's uncertain right now. But if you had to pick someone who's got an advantage, it's probably OpenAI more than Microsoft at this point in time.
Uday, we're making a really big deal of the next 2 days. We have a Fed meeting. We have 2 earnings tonight that we really care about, 2 tomorrow. On the buy side, do you look at it that way? Is anything that happens in the next 48 hours going to change your strategy or your approach?
Look, we're long-term investors. We manage a diversified portfolio of global stocks, and we have investment horizons of 3 to 5 years. So what happens in the next 2 days gives us an indication of whether our investment mileposts and investment thesis are going on track. And if something's really off, then we'll have to figure out. But I don't expect there to be any short-term news that will change our strategy dramatically. But it will keep us on our toes and trying to understand what's happening in the world, and is the direction of all the things in terms of company fundamentals traveling in the way that we want it to be, and whether we should react to it. But it's unlikely that we're going to be too reactive to whether the Fed raises interest rates or keeps interest rates flat today.
Uday Chiruvu from Harding Loevner, thank you very much. Now, coming up on the show, Palo Alto Networks has agreed to buy CyberArk software in a cash and stock deal valued at about $25 billion. We speak with Palo Alto Networks CEO Nikesh Arora and CyberArk Executive Chair Udi Mukherjee. That's next. This is Bloomberg Tech. Palo Alto Networks has agreed to purchase CyberArk software in a cash and stock deal valuing the cybersecurity company at about $25 billion. Joining us to discuss the deal, Nikesh Arora, Palo Alto Networks CEO, and Udi Mukherjee, CyberArk Software Executive Chair. Gentlemen, welcome to Bloomberg Tech. We're grateful for your time. Nikesh, I'll start with you if I may. How much was this deal? And I want to focus on the technology landscape here. How much was this deal a direct response to the Wiz Google deal? And generally, the domains the hyperscalers are focused on right now when it comes to security?
Well, I think these are very different transactions, Ed. Look, from our perspective, if you look at the last 2 years, what has gone on? What has gone on is that we're seeing this huge conversation about AI. Now, most lately, and I just saw your segment prior to this, you guys are talking about billions of dollars being spent. Well, what's those billions of dollars going to result in? The billions of dollars are going to result in tremendous amounts of AI adoption around the world on 2 vectors. One, we get very smart models out there that are going to be executed by companies. On the other side, there's going to be tremendous amounts of agents out there that are going to start accomplishing tasks on our behalf. Now, if you imagine the proliferation of agents for companies, for individuals, you're creating a whole new attack surface from an identity perspective. The more agents, the more possibilities those agents can be hijacked, taken over, and be used for cyber attacks. In that context, it became imperative for us as a comprehensive cybersecurity player to make sure we have the identity solution in the market. And if you look at the market and the identity space, and we can talk more about it, the number 1 company who understands identity security in the world is CyberArk. So we think they're poised at the right place to be able to capitalize on that opportunity of AI being deployed everywhere. At the same time, we need to have a platform that reacts in real time, because AI is going to make it easier for attackers to go and attack people quickly. So from both those vectors, it became imperative for us to make a move and deliver an identity capability in our portfolio to make sure that we can secure our customers. So that's why this makes sense.
Okay, Udi, if AI agent and the offering there is absolutely critical, what's CyberArk going to get from this relationship being a part of Palo Alto Networks, particularly like with your existing partnerships and customer base?
No, absolutely. Look, as the founder here, we had the vision that identity is a security problem, not a management problem. And then the attackers followed. And in 90% of attacks, that's how they get in, and also how they propagate. And as Nikesh said, there's an inflection point, because you add on top of that, into that fire, you add machine identities and AI agents that behave like a machine, and somewhat like, and they're also relentless like a human. So they behave like a machine and relentless like a human. So we are excited to join Palo Alto because of the scale and the technology integrations that we can bring forward. We already have integrations that we started to work on as a partnership, and we just saw that Palo Alto with its platforms can correlate data, can leverage insights to stop attacks in seconds. And together, we can bring identity security to tens of thousands of organizations out there. We're proud at CyberArk, we're proud to have 8,000 customers out there. Palo Alto has 70,000 plus customers. We have many joint channel partners, and together we're really going to go global.
Going global, Nikesh, and I get this from the platformization strategy that you have in particular. Talk to us about the operating margin and how you ensure that that remains amplified, because you've done tuck-ins, you're an acquisitive guy. How does this, in the longer term, feed profitability, feed the growth story of Palo Alto Networks?
Look, Caroline, I've always maintained for the last 7 years that if you want to be successful in enterprise, you want to be a large enterprise software company, you have to scale. If you look at every enterprise company, look at the top 10, all those companies enjoy high margins, and that's driven by the efficiencies that they get from go-to-market and sales and marketing. I think the fact that we can work with CyberArk to work at 3 levels. One, we think there's a huge opportunity in accelerating the top line for CyberArk and identity with the partnership Palo Alto. We have a global presence. We have more presence in Europe than they do. We have more presence in Asia Pacific. We have product ideas together which allow us to innovate and drive the top line. Coupled with the fact that we have a reasonably efficient backbone we run our infrastructure on. We're pushing 28, 29% margins, and we have set a target north of 30% for our company. That's going to be a huge step up from where CyberArk operates, and we think we can get them there and collectively perhaps aim for higher. Not just that on the margin side, but also on the cash flow side as a consequence of us being able to drive better margins. So we think there's synergies both in driving top line, there's synergies in bringing our scale capabilities to CyberArk's backbone and infrastructure, and I think we already articulated that this is going to be both gross margin and revenue accretive right from day one. In addition to that, we expect we'll get to cash flow accretion in about FY28, but this doesn't include all the go-to-market top-line capabilities because we're going to spend the next few months making sure we get them executed and implemented collectively or be ready to execute in cases where we need to merge them together.
Udi, are the CEOs that you've been speaking to and the ones that you're now going to win over with this combination, are they as aware of agentic AI's risk factors as you think they should be?
It's the number one thing they're hearing from their chief security officers when they ask, and when board members ask, what are you worried about now, is the proliferation of agents. And like I said, relentless agents that want to get the job done. And of course, in any simulation of an attack, they find that identity is the source of how attacks get in. So identity is top priority for organizations already, and sprinkled with AI on top, it's rising up there, and it's one of the biggest, maybe top concerns for chief security officers and CIOs.
Nikesh, I spent all morning staring at CyberArk's share price chart over the last few years. Even prior to the reporting on the deal.
As well or not, Ed?
Yeah. So I'm sure you'll tell me that this is worth every single penny, but just use it to say how pressing it was to get this deal done, the technology environment and the kind of core competencies that you acquired, even the premium that you may be paying.
Look, at 6.5, 7 years ago when I joined Palo Alto, we were an $18 billion market cap company. The only way we got where we did, north of 125, is by making sure we had a point of view of where the world's going to go in the next 3 to 5 years. What do we need to have in terms of capability to make that happen and be executed relentlessly towards it? I'm telling you today, the collective stock price of CyberArk and Palo Alto are at an all-time low. Because the next 5 years from now, you will see the demand for a comprehensive security suite across multiple platforms. We're the only players in the industry who are going to be able to deliver that. You'll see a huge focus on identity. They haven't even talked about how we can take what CyberArk does from 8 million users to hundreds of millions of users. So from that perspective, we have to do this deal now. It's going to take us 6 to 9 months to close it. It's going to take us 18 to 24 months to get the products in play, in line, to go out there and conquer this market. But we're not going to get to a $250, $300 million market cap company if we don't make these moves now and work relentlessly for the next 5 years to get there.
Nikesh Arora, talking of that market capitalization, we thank you of Palo Alto Networks and Udi Mokady of CyberArk. Great to have you gentlemen join. Now coming up, Anthropic. It's closing in on a whopping valuation too. $170 billion with a new fundraising deal. We've got the details next. This is Bloomberg Tech. Anthropic, it's reportedly close to funding a deal, a new funding deal, in fact, that would value at $170 billion. The AI startup is looking to raise as much as about $5 billion. Iconic Capital leading the round, we understand. For more, let's get to Bloomberg's Kate Clark, who helped break this story. And what's phenomenal is the valuations, but also the change in valuation.
Absolutely. Yeah, the company was valued at $60 billion just a few months ago, so this is really a tremendous leap for Anthropic.
Kate, you got some interesting details in the reporting about some of the financials, ARR in particular. What have we learned?
So the company's at about $5 billion in recurring revenue, and it's projecting to reach $9 billion by the end of the year.
You also managed to name some of the big name investors that are going to participate. And this is interesting because of recent reporting around Anthropic and Dario Amodei and his, I guess, shift in position on where they're willing to take capital from.
Yes, so it's not surprising there are a few sovereign wealth funds that are interested in investing in Anthropic. One of those funds is Qatar Investment Authority. And the reason why this is interesting is Anthropic has in the past said that it wasn't interested in taking money from some of these giant Middle East sovereign wealth funds, citing national security concerns. But in a recent memo to employees, Dario, the CEO of Anthropic, indicated that he may be a little more open to that Middle East money than he had been in the past.
The quote in your story from Dario in that memo. Unfortunately, I think no bad person should ever benefit from our success is a pretty difficult principle to run a business on. I mean, almost biting the hand that is potentially going to feed in a memo to staff, but clearly Qatar so wants in, and you have to take the money if you're going to expand in terms of infrastructure, right?
Right, and we'll see if they actually end up. I mean, maybe Dario will change his mind if he's able to get some of these Silicon Valley VCs to line up and invest, say, $1 billion in the round. The challenge is he needs $5 billion for this financing. And for the most part, venture capital firms in Silicon Valley, they're not investing $1 billion in a round like this.
Unless you're iconic.
Exactly, unless you're iconic, which is a very, very large fund and known for managing the wealth of people like Zuckerberg and Jack Dorsey. But I think by and large, there's not really a way forward for Anthropic without raising money from some of these Middle East funds.
We just showed on the screen OpenAI, XAI, and Anthropic. We've reported recently on all of them. What does this landscape look like right now for the model makers and raising some cash?
I mean, it's an incredible moment. OpenAI valued at over $240 billion, Anthropic $170 billion, XAI in talks for $200 billion. Like this, I've never seen anything like this before, and I think there's nowhere to go but up for the time being. We'll see.
Right. Bloomberg's Kate Clark and the team just smashing it on staying on top of rounds that we still think are yet to close. Now, coming up, investors have their eyes set on the growth outlook for both Qualcomm and ARM when they each report earnings later today. We're going to discuss what they're hoping to see in the results next with Bloomberg's Ian King, who leads the chip coverage here at Bloomberg. Stay with us. We'll be right back. This is Bloomberg Tech.
Welcome back to Bloomberg Tech. We have a lot on our plate when it comes to the public markets today. And look, we managed to drive higher even in the face of the anxiety of what the Fed will or will not do later today, and indeed what earnings will or will not show as we get towards Meta and, of course, Microsoft. But there's some others on deck as well. Fling it on, because I want to show that actually one company is doing particularly well after its earnings, EA. FC Sports, there's a good trend there line. We're also seeing Battlefield 6, a lot of anticipation for that game. We're up 6.4%, best day since February for EA. I'm looking at ARM Holdings flat as a pancake at the moment as we anticipate whether it can meet those 12% revenue growth anticipation. And also remember, this is a company that trades above the 12-month price target on average from analysts. So will they manage to vindicate some of the run-up in their shares? I'm looking at Qualcomm, no run-up in their shares. They've been lower throughout the year. They're down again 1.24%, Ed. A lot of this about concerns of their exposure to iPhones, to China, and notably, of course, to the auto sector too.
Yeah, ARM and Qualcomm posting earnings at the same time is not that unusual, but it keeps one man in the Bloomberg newsroom very busy, and that man is Ian King, who leads our semiconductor coverage. You know, one a chip maker, one a chip design software maker, but some stuff is analogous. I think we'll start with Qualcomm. You know, they want to tell a story where they're diversifying away from smartphone to automotive, other areas, but we will be very zeroed in on the health of the smartphone market.
Yeah, I mean, that's been the tale under the CEO, Cristiano Amon, who I believe you're going to be speaking to tomorrow. He's certainly made progress in things like auto. He's certainly made progress in things like PCs, and that's great. But unfortunately, he's still beholden massively to the smartphone market, and nobody is excited about the smartphone market anymore, at least in terms of growth. And that's what we're up against this quarter, where we might see some tariffs weighing upon that.
I mean, it is interesting that the IoT space is where they've been trying to focus. So too is the diversification into autos. Ian, ARM as well, the design company, has been trying to diversify. Is that going to have paid off?
Yeah, it's a very similar story in that, again, they're trying to get into the data center. They're trying to be part of this massive AI infrastructure build out. But on a sort of, hey, what have you done this quarter basis in terms of, where their revenue is coming in, it's like, well, what's going on in the smartphone market? How many units shipped? And so we've got these kind of dual cross currents for both companies going on. And unfortunately, at the moment, there's a considerable concern that the smartphone market just isn't that great a place to be.
Between the two companies, ARM and its relationship with Qualcomm, there is some tension, some beef, as the kids would say. Why and what's going on?
Yeah, I mean, there's a legal case which is dragging on. Qualcomm already won one round of it. We're looking at maybe we're going to appeal that. Lots of tension going on there, but basically because ARM is trying to essentially become more of a chip maker, more like Qualcomm. Qualcomm made an acquisition of another licensee of ARM technology. So there's this tangled dispute, but fundamentally it's because these two companies are essentially becoming more competitors than partners than they were in the past.
The kids don't say beef anymore, according to Bloomberg tech producer Marguerite Gallerini, but we will still be watching out for something. Bloomberg's Ian King, thank you very much. I want to stay on semiconductors and bring in Beth Kindig, lead tech analyst at IO Fund. And I'll start with Qualcomm, I think. I always look at the earnings print and the commentary and then try and get a bigger picture on the smartphone market. Sometimes Cristiano Amon can say, here's what we see, around the world in our key end market. What will you be looking for, Beth?
Great to see you, Ed. There's many reports tonight, and when I think of Qualcomm, very briefly, what I would say is being hung up in that mobile market. This is not the biggest growth market for AI right now. You can see that evidence many places, whether it's Apple, Qualcomm, pick anywhere really in the mobile stack. For me, Qualcomm is more of an automotive story. I would look more closely at Qualcomm toward the second half of this decade. So year 2028, year 2029, year 2030, especially as AI moves more toward the edge. And when you see AI move more towards the edge, Qualcomm would become more interesting at that time.
More interesting in the longer term. In the near term, talk to me about the valuation of ARM, because it has basically risen above where most analysts think it should be currently priced at.
Yeah, that's a great point. The one thing about ARM is this valuation, for me, is not justified. The royalty rates, they've doubled with V9, the architecture V9. But ultimately, why would I pay more on the sales valuation for ARM than I would NVIDIA, Broadcom, these massive design companies that are taking market share versus a royalty rate somewhere in the 4% range? To me, it just makes much more sense to participate directly. And we've already seen that during the mobile era. Would you have rather owned ARM? It was a private company, but would you have rather owned ARM or Apple? Apple, of course. And I think something very similar is going on with AI.
Okay, let's talk about the here and now in what's happening in AI and what we're about to hear after the bell as well, because I know you have a very keen focus on the Meta and the Microsoft story as well. Look, are these companies going to vindicate the amount that they are currently spending on their underlying infrastructure?
When I look at these companies, I think Microsoft is the one putting forward, putting its best foot forward. This company, the last time it gave us a number, it was $13 billion on Azure with a 175% growth rate. Sometime in 2026, I wouldn't be surprised if Azure reaches $40 billion contribution from AI. That is a massive number. And then keep in mind, it's not just the size of that number for Microsoft, it's the rapid ascent in reaching that number. And that piece, I think, really does separate Microsoft as the enterprise AI juggernaut.
Beth, I really appreciate that explanation, because what Microsoft does, right, it says here is a percentage point growth figure for Azure, and here is a points contribution specifically from AI. It's a different way of communicating than, say, Alphabet does or Meta does. But is it enough for an investor like you to say, I understand where all this investment has gone, what's coming out the other side?
When we are talking about $40 billion potentially in 2026, I would say yes, we are reaching a scale that is very meaningful, reached it very quickly. And again, it is that contrast that you pointed out, Ed, which is that many of the peers are not discussing specifics in terms of dollar or growth rate from AI. And it is that contrast where Microsoft stands apart.
I'm going to ask you something which might be a little unfair, but if we put Meta and Microsoft as direct competitors in an AI race, and let's just throw OpenAI in there as well and Anthropic, how would you rank them? You know, Meta has been putting out a lot, even this morning, about their vision for superintelligence, but where would you rank the competencies and leadership in the marketplace?
You know, on the public markets, I have to go with Microsoft because of the real revenue that is there. Meta is my number 2 out of those bigger tech companies. So Amazon, Alphabet, they would rank much lower. I don't like Meta's valuation. This valuation is at a historic high. Meta has participated in very explosive trends such as mobile and social media. I can't justify Meta's valuation either right now. Meta lower, though, is easily my number 2, second to Microsoft.
And then let's look a little further afield, if we may. So Microsoft and Meta tonight, Apple and Amazon tomorrow. Which of the evenings are you most excited about?
I will be bold and say I'm not interested in Apple or Amazon at this time as an AI investor. I want to see more from these companies. AWS needs to get up off the floor a little bit here and start to accelerate. Apple, similar to Qualcomm, you know, they are the smartphone market, they are the edge AI. There will be a moment when that will lead. It's not right now.
Beth Kindig, not excited about the calendar of the 48 hours to come. We're excited to have Beth Kindig, lead tech analyst at IO Fund, back on the show. Thank you very much. Caroline, you got some news.
I do. It's time now for Talking Tech, Ed. And first up, Tesla. Well, it's agreed to buy $4.3 billion worth of US-built batteries from LG Energy Solution. It's all according to a source familiar with the deal. Now, LG Energy revealed the contract without noting the customer in a regulatory filing. Tesla is working to expand its supply from non-China-based suppliers, of course. Plus, Foxconn, well, it's formed a pact that should help its push into AI hardware. Now, a share swap deal with Taiwan's Teco Electric and Machinery really underscores Foxconn's ambitions to move beyond iPhone and server manufacturing into fuller AI data center construction. And in a reversal from the Australian government, YouTube will be included in a social media ban for children under 16. Platforms including Instagram, TikTok, and now YouTube will face fines of up to $32 million if young teens use their service starting on December the 10th. YouTube's position is that it's not a social media company yet.
Okay, coming up, cybersecurity top of mind today in M&A. We're going to speak with Cato Network CEO Shlomo Kramer after it recently raised some new funding, also one of the early investors into Palo Alto Networks. It'd be great to get his take. Stay with us. This is Bloomberg Tech.
Cyber M&A is dominating headlines this morning as Palo Alto Networks and CyberArk reach a $25 billion deal. Here to discuss some of those trends, the landscape, and their own fundraising, Shlomo Kramer, Cato Networks CEO. Cato Networks is an Israel-based network security company, valuation of almost $5 billion, Shlomo, and you've been raising funds in a Series G. I'm really interested in, as someone who put the first seed check in, you were one of the first board members of Palo Alto Networks. What do you make of this platformization, this idea to be going broader and broader as cyber security companies?
Right, so I think it's a bridge too far. And we've seen the next generation ARR growth of Palo decelerating over a number of quarters recently. And that's because they don't really have a platform at their core business, their network security business. They have platformization, which is a promise, which is a crusade to nowhere. It's a promise that will never materialize. And the extension to a completely new platform, the identity platform, has failed in the past to any pure play security company. I think the only one that pulled it off is Microsoft because they owned the underlying operating system. But customers want a platform-based solution but they want to choose the network platform, the endpoint security platform, the identity security platform, and the cloud security platform.
And this is a philosophical difference you have, and ultimately why you went out and set up Cato Networks in many ways. And
right.
boy, you've taken Checkpoint public, you took Imperva public, you're a man who knows how to build businesses. But I'm interested, as you build Cato Networks, what is it that you're seeing? Why is it people are still putting money into you when you're not yet a public business?
Right. First of all, because we are growing at 46% year over year. That's our last published results. And we are at the beginning of a huge market. The remaking of the network security market. It's a seismic change. It's interesting that Palo is now expanding beyond that because there's so much work to be done here. It's a $100 billion market that is going to be re-architected in the next 10 years.
Because of AI?
And that's the network security, network security, not including everything that AI will bring. So it's really interesting. It's a huge opportunity. It's just the beginning. In the next 3 years, 60% of enterprises are going to start their migration to SASE based on Gartner. Less than 15% have started it. Mm-hmm. And it's going to be 80-90% of that market is going to transform from appliances to SASE. So it's, I think that's why Cato, as the only platform that was built for SASE, actually inventing the category, is continuing to grow so fast. And that's why we are going to be laser focused in the next decade on network security, not identity. And
SASE, for those who aren't completely into the lingo, Secure Access Service Edge. Ed.
Exactly. Thank you.
Shlomo, I get the different domains, like CyberArk is in identity security and privileged access management, but what you both have in common is the enterprise market. And one of the things I was asking Udi and Nikesh about this morning was how much pressure there is coming from the hyperscalers. You know, think about Google Cloud and its acquisition of Wiz. They have offered more of their own security tools. Are they your competitors?
Not at all. Zero pressure. Microsoft has been at least on the network security side, we see zero pressure. The only player that came in is Microsoft, and we're not seeing them. They definitely do not have the clout on the network side. Another example why different geographies in the organization need different leaders. The network security side, we are not seeing any of the hyperscalers, and I'm not expecting any of them coming in anytime soon.
Put it another way, after a big piece of M&A in your industry, and I appreciate you just raised funds, but do you think that somebody might look at Cato Networks?
I think we are building here a long-term, independent player, and that's the goal. And as I mentioned before, this is very early in the game on transforming the network security market, network security market from the second generation appliance-based and digitally transforming it to the cloud. This is a 10 years journey that we are excited to embark upon.
10-year journey. Look, you're someone who I said at the start takes companies public. A Series G already worth almost $5 billion. I mean, what are going to be the perfect precision points for then taking this company public?
This is a good question, and we continuously evaluate that. We are a hyper-growth company, so we have options both on the public and the private, and we'll continue to consider both options. I can tell you that we as a company keep a very high level of readiness. So once we decide that this is the right moment, it will not take us a long time to be public.
Shlomo Kramer of the Cato Networks, it's great to have you back on the show. Thank you very much.
Thank you.
Okay. It was almost a historic day for Australia's space ambitions. Gilmour Space launched its made in Australia Eris orbital rocket. Payload, a small jar of Vegemite spread for toast. But the rocket didn't get very far, crashing just 14 seconds after liftoff. Still, the company sounded upbeat, posting on X, big step for launch capability, team safe, data in hand, eyes on test flight 2. we'll keep tracking what's going on in Australia's space industry, Cara.
I'm a Marmite gal rather than a Vegemite gal, but I like that payload. Coming up, Figma, well, it readies for an oversubscribed IPO with its CEO set for a huge pay bonus. More on that next. This is Bloomberg Tech. Figma CEO Dylan Field, well, he's already amassed $1 billion fortune as the company readies to IPO this week, it would seem. But the co-founder of the design software company could receive another $2 billion pay package if the company's stock hits certain goals. This is Figma's IPO is already approaching 40 times oversubscribed. It's all according to sources. Let's get to Bloomberg's Tom Maloney. He's really written about the pay package here. And look, this is a theme. This is about really tying in the key man in building this business for the longer term.
Yeah, that's absolutely right. And that's what they've done. Just last month, they inked a new compensation deal for him, and that's going to give him up to 29 million shares. As you mentioned, it's split into a performance target where he has to get the share price up to between $60 and $130. If that kicks in, he's got 10 years to do it. And then there is a time vesting portion of that deal as well. All up, it could be worth $4 billion if he hits the top of that share price range.
Tom, for lots of our audience on Bloomberg Tech, this is just like core to the story of founding a company and taking it public and growing a startup. The numbers that we went through in terms of like his ultimate comp from this, how does it rank with some of those kind of big name IPOs where the CEO stands to benefit?
That's a good question. I mean, you know, it's so hard to do comparisons between these kinds of packages because the stock prices move around so much. Some of them really work out and some of them don't. We mentioned Airbnb in the article. I was just actually looking at an older story we did on the Rivian founder who had a very similar package. We wrote about that. He could make billions. That was when Rivian had a $100 price handle. Today it's trading at 13, so that just didn't go anywhere for him. So, you know, look, sometimes these moonshot packages really work out and other times they don't.
And sometimes you get a tattoo because of it. I mean, I think it's Axon Enterprises taser maker, basically. Rick Smith had a tattoo when he got a certain amount of benchmarks through his $2.5 billion pay package. Is there ever any sort of saltiness coming from the future investor base about this? Look, I just think of what Elon Musk's pay package has meant so much for Delaware and the court fight there.
Yeah, look, I think at the end of the day, even with Musk, I think that's a great example. It's a massive package, and I think a lot of people on the outside are upset about it, but at the same time, it received investor support. I mean, they just voted for it again. So if you're an investor and you see your share price go up by, you know, 3, 4, 5, 10 times, then I guess you're inclined to be generous.
Right. Yeah. Tom, just really quickly, remind us of what happens now. When's pricing, when's listing, how oversubscribed the round is, just the other details.
Yeah, 40 times oversubscribed, pricing today. Trading begins tomorrow. You know, I didn't mention he has a 2021 pay package that he is still collecting on. Depending on how pricing shakes out, that could vest in the very near future as well. So adding more to his wealth.
Yeah, wow. Of all of the IPOs we've covered, Caro, take a look at that chart and how much demand there is for Figma. Bloomberg's Tom Maloney with a great handle on the numbers, but this is one, maybe one of the year. It's an IPO of the year. Sadly, that does it for this edition of Bloomberg Tech. But Caro, my goodness, brace, basically.
Brace. We are anticipating so much in terms of After the Bell. Don't forget to check out our podcast. You can find it on the terminal as well as online on Apple, Spotify and iHeart. Meta, Microsoft, Qualcomm, ARM, not to mention, of course, a key IPO. We're looking for that pricing too. This is Bloomberg Tech.